What do you think the most important thing about the loan is when you're purchasing the home?
To close it.
Absolutely. Yeah, it's not the rate.
That's how I feel personally. I always like working with a mortgage broker. With you, we've done 5 together, I think. And for me, it's knowing that I'm going into a transaction with someone that I can trust, that's going to be accountable, that's going to be accessible, that is going to close. And I'm not going to have to be chasing and wonder where they are and that they flake out. And so when I get something under contract, I know where I'm going, and that's the main driver. If the rate's a little bit lower, a quarter point, it doesn't bother me. I'm that thought.
Real estate as a business is not a thing for my family. The market started to get really pretty wild here.
Your underwriter, and to approve them and make sure that they can qualify and make payments for the loan, you have to have it so buttoned up because you're going to go and sell it. Buyer and operator, you want to have your books, and you want to have the leases, and you want to have the expenses and everything running in a way that if someone else comes in to buy it, it looks like a good business.
A buyer's in a terrible position because they want to shop for a mortgage, but before they have a property under contract, it's too soon. Choose the house, then you don't get to choose the rate. It's difficult. And over the course of my career, I've watched the commoditization of the mortgage business, where generally the consumer feels like everyone is offering the same thing. So why don't I just take the lowest price? We were moving sand from one side of the beach to the other. You look down and you're like, I didn't make any progress. Right, and it kept going, and I think that most homeowners got the opportunity to take advantage of it. It was a unique market for sure.
With that trajectory. So, you did a 1031 exchange with your share of the proceeds from that duplex that was an income property, meaning you didn't have to pay taxes on, it was probably a pretty nice appreciation and proceeds. So you deferred that as long as you bought another income property that you weren't going to live in. Welcome to All Things Real Estate with Ari Wintraub, a show where we get to meet and learn from players within and around the real estate industry. An industry that provides incredible opportunity for creativity, entrepreneurship, and wealth building. Join me as we learn the tips and tricks from these insiders and helping us to carve out a space within this massive industry. Hi, everyone. Welcome back to All Things Real Estate with Ari Wintraub. Today, I'm very excited to have Justin Bayle from Lend LA. He is a residential mortgage broker, and he's going to share with us all the tips and tricks involved with getting a mortgage and buying a property. He has tons of experience. He's been my residential mortgage broker for many years. He does his own investments. He's a wealth of knowledge. So without further ado, Justin, good to see you.
You too, Ari. Thanks for having me. I really appreciate it.
Thanks for coming on.
Yeah, man. We go way back at this point, huh?
I know. We certainly do. And you go back to the time where I was just an ambitious buyer, couldn't get qualified, and I would, suck up your time coming down to your office.
No, man, that was great. I mean, feels like a lifetime ago, but also just yesterday, right?
Yeah.
Yeah, I remember when Mike Deasy actually made the introduction.
100%.
Yeah.
Yeah. So that's been an amazing relationship having you as a resource for myself and for my clients. And just to start off, let's hear how you got to where you are and what your backstory is.
Sure. Like many people, I kind of fell into the mortgage business. I don't think there's a lot of fourth graders running around saying, I want to be a mortgage broker when I grow up, right? It's just not really on the radar. But I moved to LA in 2000 with right out of college, with a girl, of course. And she was going to grad school at UCLA. And I thought, like many of us, you can probably relate, let's go to Hollywood and work in the entertainment industry and do all that, right? And those were the good old days where when you needed a job, you just went out and found a job. Like I needed a job to pay the bills and pay the rent. We had a little apartment in Studio City, and I just pounded the pavement. And a few days later, I ended up at Gloria Schulman's office, she's a legend in the mortgage business in Beverly Hills. In fact, she's still doing it. I won't give away her age, but she's been doing it for a long time. And so I didn't know what I was doing. I just sort of started out pushing paper around and helping her with marketing. And I come from a very blue collar Midwest background. Real estate as a business is not a thing for my family,
Right.
or historically wasn't.
Right.
Right? It was, yeah, maybe you bought a house, but that's kind of where the story ended.
Right. It's
Right?
not like here in LA, everyone's a professional real estate person.
Right. Right. Isn't that the saying that the other business in LA is real estate?
Yeah. Yeah.
Right? Outside of the entertainment industry. So, I ended up doing that, was kicking around in the entertainment industry at the same time. She was flexible about it. And, after a few years of that, the market started to get really pretty wild here in Southern California. So about 2003, I decided to dedicate, full time to that. And, got licensed. One thing leads to another. And pretty soon you have a lifestyle, and that's
Okay.
where it goes. So,
Yeah. Great.
yeah.
So you've been doing that now over 20 years. And so what's the difference between a mortgage broker and a mortgage banker?
So a mortgage broker exclusively does third party lending, meaning I take an application from a buyer or borrower, and decide where the best place to place it is. A third party,
Right.
not under my control of funds or my control of operations, underwriting, um, that type of thing. A mortgage banker facilitates that transaction with control of funds, control of operations, has a staff of underwriters, a staff of processors, lends their own money. In the mortgage banking world, most of the time, if you're not dealing with retail, like a big Bank of America, Chase, one of these big retail institutions, the mortgage banking world, while we say we're lending on old funds, that's not really the truth. The truth is that, um, we're because just to clarify, I'm actually a mortgage banker and a broker.
Okay.
We do both.
Right.
Most of traditional transactions we bank. But what we're really doing is we're quickly borrowing that money from a warehouse line that's pre-established, lending it to you or Joe consumer, and then a few days later selling that loan. Most of it goes to Fannie Mae, Freddie Mac. Um, then we have other portfolio investors who purchase jumbo transactions, non-QM, and then of course there's government lending, FHA, VA.
So when you say it's a warehouse loan, again, that's not your bank's money. That's not your company's money. It's a line from like a United Wholesale Mortgage.
Right. So we don't deal with United Wholesale Mortgage, but there's a lot of institutional lenders who we have established lines of credit because we don't, we on average fund about $25 billion a year. We don't have $25 billion to lend.
Right.
If we started lending out money, we'd run out real fast.
Right. What
Uh,
percentage would you say is your funds?
None of it.
None of it. Okay.
Almost none of it. Yeah. I mean,
Again, unless you're like a retail, like a Wells Fargo, a Citibank, a Chase.
and keeping it in your portfolio.
Right.
Right. Even they might have a warehouse line set up for themselves. They lend the money out and still turn around and sell those loans to Fannie Mae, Freddie Mac, Ginnie Mae, who handles FHA and VA transactions. Um, so yeah, it's kind of a technical thing. It's probably not
Right.
really important to the consumer, but that's the reality of the
Okay.
situation in terms of the difference between a mortgage broker and a mortgage banker.
Got it. Got it. And then when will you guys decide to service it? So, you get a mortgage. It doesn't really matter so much where the funds
Mhm.
are coming from. The assumption, if it's a retail institution, it's going to be their money, but then they may sell it off and not keep it on their books. But
Right.
with you guys, you're going to be the servicer. So the loan closes, people are making payments to your company, and you guys are servicing the loan,
Mhm.
and it appears that it stays with you guys.
Right.
When do you guys stop servicing the loan, and does that mean necessarily that it's been sold?
It's a great question. Um, so your loan can be sold and still appear to have not been sold because it's still serviced by the original
Right.
lender.
You may get a letter
Is
saying that it got sold, though.
You will get a letter saying it's sold, but then you realize you're going to the same platform. It's still all branded as Movement Mortgage or whoever you got the loan from. Um, And the reason for that is because there's a value in loan servicing.
Right.
It's anywhere in the neighborhood of 25 to 50 basis points of the loan amount that on an annual basis that whoever is servicing that loan takes as a fee in exchange for handling the payments, the processing. They're in charge of if there's ever a default. There's a lot that goes into it, handling escrow accounts for
Yeah.
taxes and insurance. All of that has a value. So when we're determining if we're going to retain that servicing or sell the servicing, revolves around what's the current market value of the servicing,
Right.
and do we want the cash or do we want to retain the servicing and collect that 25 to 50 basis points um, every year, as opposed to taking maybe 200 and 250 basis points today
Right. By selling it.
by selling it.
Right.
Right.
Exactly. And that goes into you guys being very strict in the underwriting, because when you guys are qualifying someone for a loan, it's not just to satisfy your underwriter and to approve them and make sure that they can qualify and make payments for the loan. You have to have it so buttoned up because you're going to go and sell it.
Yeah, the term is salable. It needs to be a salable loan. And you'll find this with every lender. Anyone who's closing on a transaction, there will be a disclosure in there that says we retain the right to sell servicing. And of course they do, because I mean, what happens if the bank goes out of business?
Right.
What happens, Countrywide was the largest servicer in the world for a long time, and then in a matter of a few months they went belly up. Well,
Right.
if you couldn't sell those loans, if they didn't have a value, then it would be impossible to even lend.
Right. It's very much on par with like if you're an apartment building buyer and operator, you want to have your books and you want to have the leases and you want to have the expenses and everything running in a way that if someone else comes in to buy it, it looks like a good business.
Right.
And so it reminds me of that.
Yeah, absolutely.
Yeah.
Absolutely.
Okay, so we get a good sense here, of what you're doing and the fact that, you're sourcing money from other, large, asset funds to fund the loan, and you guys, are going to service it or not. Um, and so one of the questions I have, and I imagine this is like a really big part of what you do, is how many people are hitting you up and what I would call being really rate sensitive.
Right.
So they're constantly, asking you, when the rate's going to come down and if it's the right time to buy and, what are the payments based on the rate. It's not just a matter of like, can they qualify, can they buy, but like, can you tell them, what the rate's going to be and how do you manage that?
It's difficult. It's difficult. And over the course of my career, I've watched the commoditization of the mortgage business, where generally the consumer feels like everyone is offering the same thing. So why don't I just take the lowest price? The reality is that a buyer's in a terrible position because they want to shop for a mortgage, but before they have a property under contract, it's too soon because the rate could change by the time they go under contract.
Right.
And they might have to go back. If they talk to 3 lenders, they might have to go back to all 3 lenders every day to find out, did they change their strategy? Did their rates go up? Did they go down? And then, at least in the Southern California market, where we have these short escrows, there's a lot of demand, there's a lot of competition, you need to perform quickly. Once they're under contract, it's too late to start shopping.
Right.
Because they don't have time.
Right.
They can't go back and get quotes from everybody and restart applications and do all of these things. So,
Right.
unfortunately, in Southern California, it's very difficult for a buyer. For that reason, mostly, I tend to tell people that when you're purchasing a home, is not the time to be rate sensitive.
Right.
You have to, obviously, you want to work with someone that you feel is competitive, has your best interests at heart. You can do a lot of that due diligence. But if you start to focus on, someone's an eighth lower, someone's a quarter lower, this guy's an eighth higher, I tell every client who calls me, I said, if you shop around long enough, I guarantee you're going to find somebody
Right.
who's going to offer you a lower rate.
Right.
I don't know. Will they close?
Right.
Will they not? Will they make your life difficult? When you're purchasing the home, what do you think the most important thing about the loan is when you're purchasing the home?
To close it.
Absolutely.
Right.
Yeah, it's not the rate.
Yeah. That's
Uh,
how I feel personally. I always like working with a mortgage broker. With you, we've done 5 together, I think. And for me, it's knowing that like I'm going into a transaction with someone that I can trust, that's going to be accountable, that's going to be accessible,
mhm.
that is going to close.
Right.
And I'm not going to have to be chasing and wonder where they are and that they flake out.
Right.
And so when I get something under contract, I know where I'm going, and that's the main driver.
Right.
If the rate's a little bit lower, a quarter point, it doesn't bother me. I'm of that thought.
And I think if I'm doing my job, I'm establishing a relationship with you and trust so that the day we close, now it's time to be rate sensitive. Now I've got your profile, I have the transaction. Now I can watch rates for you. Now I can call you the minute it's time to refinance.
Right.
I can track the market for you. And when you're refinancing, then you want to be rate sensitive.
Yeah.
You want to be like, I want to get to the bottom.
Right. Yeah.
Um,
You own it. You've got it. It's yours in your portfolio. Then you can be really
Right.
sensitive.
So
That makes sense.
So at that point, are you dealing with an expert who really understands the mortgage market, the mortgage-backed security market? Are they tracking it, larger trends? Because refinancing has its own sort of drama associated with it. You don't want to pay a ton of closing costs if rates are continuing to go down. You see a lot of lenders
You're talking about buying down the points.
buying down a rate because that becomes sunk cost. Or even just general escrow and title and those types of closing costs.
Yeah, that's a question that people would have,
Mhm.
is when to buy down a rate when you're in escrow. And the question is like, how long do you think you're going to have the loan for?
Right.
Right?
Exactly.
Can you explain that?
So when you're purchasing a loan, you hear about points, right? Okay, so a point is 1% of the loan amount. If you've got a $500,000 loan amount, 1% is $5,000. There's a spread of coupons that cost different points, different amounts of points. It might be a fraction of a point up to multiple points. Let's just hypothetically say you've got a 7% interest rate today is no points, zero. It's par is the term we use. 6.75, a lower interest rate might cost 1 point. 7.25, the lender might give
You
you
mean
a
to
point.
buy down what we say 25 basis points from 7% to 6.75 is going to cost you 1% of the loan amount.
I'm using it as an
But
example.
that's how it could work, right? It
Yeah.
could cost $5,000 to buy down a $500,000 loan.
Right.
Right.
And I'm just using it as an example. What becomes difficult is that there's no consistency in that.
Right.
In some markets, it might be 1 point to get a quarter in interest rate. In other markets, you might pick up a 0.5% in interest rate for 1 point. So you've got to be
Right.
in tune with the market
Okay.
and when it makes sense or not. But I think
And when it makes sense is dependent on how long you expect to carry the loan. Like right now, people are hoping the rates are going to go down, and maybe they do go down 50 basis points or a whole percentage point. If that happens within 2 years, it's probably not worth
right,
spending the money up front to buy it down.
absolutely.
Okay.
Yeah, you do. If you think rates are going down, you absolutely do not want to pay points. In fact, you should really follow the opposite strategy when you're making a purchase. And if the lender is offering you a higher interest rate
Right.
with a credit, you should consider
Interesting. I've never
taking
heard
that,
that before. Interesting.
right? So imagine if you were getting $1 million loan and I give you 7% at par today, or I can say at 7.25, I'll actually give you 1 point
Right.
towards your closing costs. If you're tight on cash, maybe
Exactly, yeah.
that's a great strategy.
Yeah.
Here's $10,000 to offset your closing costs. If you're going to refinance in 6 months, 9 months, a year,
Right. Paying that extra quarter point on 2 years of interest payments is not going to be as much as $10,000.
right? The quarter point is going to be about $210 a month.
Got it.
It's going to take you, what does that work out to be? About 50 months before you spend $10,000.
Yeah. This is great stuff. And I want to like kind of layer in some more of these, you know, strategy for buyers and the things that they could, be watching out for,
Mhm.
the different type of loans. But going back to this rate sensitivity, it reminds me of this Wall Street Journal article that came out about 2 weeks ago saying that finally, since 2022, when the rates jumped up and doubled, we're now finally seeing buyers coming off the sidelines and buying. And they're just saying, forget it. The rates are what they are. We're not going to
Right.
be out of the buying market forever. It's been 3 years. And in that
Shock
article,
is worn off a bit. Yeah.
right, shock is worn off. And one of the quotes in that article was this expert saying that the best time to buy is when you can afford to buy. And I loved that because that's, my, thought and
Mhm.
my belief. If you can afford, you can buy something, do it, because long term, you're going to benefit from the appreciation and owning the asset and all the things that come with owning real estate. And so I just love that. And I don't know if you ever
Right.
kind of give the same advice.
Yeah, I have a tendency to tell people, if you want to choose the house, then you don't get to choose the rate. You have to accept the market rate at the time that you're choosing the house. Otherwise, if you want to wait and be like, okay, when rates hit this number, I'm buying the house. Well, then you've got to buy the house that's in front of you at that moment.
Right.
Whoever does that,
Exactly. Yeah.
right? No one.
Right.
They want to choose the house.
Right.
So you then have to accept that, the rate is going to be what the rate's going to be.
Yeah. And if you can
when
afford
when
it,
the right house comes along.
right. And if you can afford it, then you do it.
Right.
Makes sense.
Yeah.
So what other kind of strategies? We're talking about buying rates down. What kind of loan programs have you seen buyers take advantage of? I know a few years ago, and people, I encourage them to jump back on my YouTube and watch the video we did about buying a multifamily property with an FHA loan.
Right.
I always love that strategy. But what other, loan programs are you a fan of? Do you recommend you see people taking advantage of?
There's been a huge rise in what's called non-QM mortgages, non-qualified mortgages, which means that they don't need to meet the specific requirements of the Dodd-Frank Act necessarily.
What's that Dodd-Frank Act?
So after the Great Recession, 2008, 2009, the Dodd-Frank Act was passed through Congress, which created the CFPB, the Consumer Financial Protection Board, which has now recently been a little bit dismantled with the Trump administration coming into office.
Right.
To be determined how that's going to play out long term. But it created that and created a whole bunch of regulation around lending and around compensation for lenders, all of these regulations and compliance that we now need.
A lot about
Be-
qualifying people.
A lot of it was around qualifying people because what they determined as part of the Great Recession was that we were giving loans to basically anyone with a heartbeat.
Right. Obviously,
without proving their ability to repay. So that became the term ATR, ability to repay. You need to prove that they have the ability to repay this mortgage, or you cannot lend them money. And if you do, they have the right to litigate against the lender for lending them that money when they didn't prove that they had the ability to repay it.
wow, I never knew that was part of that.
Right. So
Yeah.
that was the premise behind it, that the lender would be insulated from litigation as long as they proved that the borrower had the ability to repay at the time of giving the mortgage.
Right.
That was
Yeah, that must. And I want to hear about the unqualified mortgage that you mentioned, that strategy. But going back to that Great Recession, you were in the business, you said, since 2002.
Mhm.
And so, leading up to that Great Recession, and obviously they kind of look at the whole industry as like a blanket. They said, okay, lenders were making, bad loans.
Right.
It's not every single loan, but there are certain bad actors. That must, make your job harder now that you have to go through all these, regulations. How has it changed your practices? Do you think that they're all good measures? Was it, long overdue? How did you guys see yourselves,
Yeah.
in this?
I think for the most part, it was overdue, well-spirited litigation, or I'm sorry, uh, what's the word I'm looking for?
Measures,
Yeah, well-spirited measures,
regulation.
regulation, that was the word I was looking for, and it certainly created a bunch of challenges, creates a bunch of paperwork, as these things have a tendency to do, but
Oh, it's like crazy. Like,
right,
myself and my clients, it's like brain damage. Like the amount of docs, they want to know what, you were buying a
right,
cappuccino for at Starbucks on your bank statement. You have to prove that. Why?
right, right. The big thing was prior to that, I could make more money if I sold you a higher rate. Post Dodd-Frank, I get paid the same amount on every single loan, whether I give you a higher rate or a lower rate. I have no motivation
Right.
to do that. And
Okay.
I think that was the spirit of it. They wanted to remove that incentive to take advantage of people
Right.
when they didn't know it. They
That's
didn't
great to
realize it.
know that that's in play. I had no idea. Like, it's interesting. There's all these regulations, all these changes. So many people saw the movie The Big Short, which taught a lot of us about the secondary mortgage market and how
Right.
they're sold off. But I don't think most people know about these rules and how things have changed.
Yeah, I don't think so either. And that movie, that's funny. My brother's actually in that movie.
No way.
Yeah, he's sitting at, I don't know, it's a poker table or a blackjack table or something.
Well, what's the
In one
scene?
scene, yeah, he's in the scene. He's Brad Pitt and I don't know who else. They're all sitting at the poker table, I guess, or it's a blackjack table or something in Vegas. And he made it into the trailer. He's got a bit parted, and he made it in the trailer because his line is, "You're gonna bet against the banks."
Right.
You're like, well, that was like sort of the premise of the movie. That's The Big Short,
Right.
right? And so he made it in the trailer. But that movie gave a very dramatic insight into that world. The money was flowing. There was a lot of people taking advantage of it, living these extravagant lifestyles, and it because I started working for Gloria. Um, she very quickly instilled in me about building a repeat and referral business. I didn't realize at that time that most of my contemporaries, most of the other lenders who were in their mid-20s were out there selling these subprime mortgages, making money hand over fist, cold call in, chop shop,
Right.
this whole situation. They were making so much money. I I was just sort of oblivious to it.
Right.
I
Right.
was in there in this very traditional,
Yeah.
how do I establish relationships with people like
Yep.
Ari and Mike Deasy and all these other realtors that I
Right.
started
She
to
was in it for the long game. She didn't just pop in, during that era to make a
Right,
quick buck.
right.
Yeah.
Um,
It's
so
so true, the company you keep. At Sotheby's, we see, the practices, the level of service, the level of marketing, um, and there's other, offices out there where it's not at that level, and it's the
right.
same with you guys. It's the company you keep and the office that you're in
Mhm.
that sets the standards.
Yeah, absolutely,
Yeah.
absolutely. So, a lot of the stuff that happened in that movie, that was very true. It was very,
Right,
very accurate.
but it wasn't entirely what was happening.
It wasn't entirely that was what was happening, and I think the big takeaway is that it was a top-down problem at that time. The Wall Street demanded these loans. They had a market for it. They were making a ton of money, and, by the time it got down to the lender originator level,
Right,
they were just fulfilling the demand.
right,
Not that they're not culpable.
sure.
Everyone
Yeah.
had some culpability,
So
but
now we got, stiffer regulations
mhm,
and some, way to hold people accountable.
right,
And so now you're talking about these non-QM loans. So now it's like leaning back into, so how do
right,
you phrase that? It's like it made it too strict
right.
when there's people that might work in Hollywood. They're like a self-employed, screenwriter.
Mhm,
They make good money. The income's inconsistent.
right.
So is that what that is for?
Right, so the non-QM now really caters to self-employed people or individuals who have still have the ability to prove repayment, but maybe not in the traditional means, maybe not with 2 years of tax returns. Maybe the money is inconsistent. Maybe they have millions of dollars in the bank, but they don't really have any income
Right.
because they don't need any income because they've got millions of dollars in the bank.
Right.
So what are these other alternatives that we can use to lend them money, give them a mortgage, qualify them, and still sort of insulate ourselves from potential blowback of their inability to repay or
So how do you do
default.
that? A lot of listeners and a lot of people in LA would utilize something like that. They
Yeah,
might be in the cannabis space. They
right,
they may be a real estate investor. They may be a flipper. So how does that work?
right. So one of the most prolific loans that I write is a bank statement loan. It's a non-QM where we use 12 months or 24 months of bank statements and do an analysis of the business cash flow. And we use that as your qualifying income instead of your 2 years of tax returns or those more traditional um, means of qualifying. Uh, Now, there's a premium on that mortgage, right? Because it's non-traditional. It's not going to be. It can't be sold to Fannie Mae or Freddie Mac or Ginnie Mae or any of these traditional government-sponsored
So they might be able to
companies.
sold somewhere else, or
Right.
no, the lender's gonna have to keep it on their books regardless.
There's funds in all sorts of other places who
But
are
not as
sort of
many.
aggregating those, right?
Yeah.
Because they're getting a premium. If the going par rate today is 7%, the delta for a non-QM loan, which is actually much smaller than it used to be, is anywhere from 0.5% to 1%
Okay.
higher.
Right.
A couple of years ago, it was closer to 2%.
Right.
It's a great strategy for self-employed people. And I try and coach clients to not get hung up on the interest rate and look at your whole global financial picture.
Right.
You can leverage income tax strategy and minimize your income tax obligation, still get a mortgage. You might be paying a higher interest rate on that mortgage, but you've offset it so much by having an aggressive income tax strategy that it's 100% worth it.
Right.
Let me just give you a quick example.
Please. Yes.
Make the math easy. Let's talk about a $1 million
Okay.
mortgage. Let's say that the par rate today is 7% for a traditional mortgage.
Okay.
And if you need a bank statement loan, it's going to be 8%. It was a 1% difference.
Right.
On a $1 million mortgage, that's going to be a $10,000 more in interest that you're going to pay every year
Right.
by taking that. And
Like-
that could be tough to swallow,
Right.
right? Oh, your neighbors, well, my neighbor got 7%. Why am I paying 8%?
Right.
Well, in order to qualify for a $1 million mortgage, you have to show net income $225,000, $240,000 on your tax returns. If you're utilizing an aggressive income tax strategy and maybe you're writing that down to $100,000, now you don't qualify for the mortgage. Well, what have you saved in income tax between $240,000 and $100,000 in net income?
Yeah. 50,000, maybe 40.
Yeah, maybe
Right.
$50,000.
Right. And if you're only going to keep the home for 2-3 years.
Even if you're going to keep it longer, you've still beat out the neighbor who's got the lower interest rate by 30 grand,
Right.
right? You've saved $30,000.
Yeah.
But people don't always see it that way. So it takes some coaching and
Again,
takes
people are
some,
really rate focused.
right.
They really are.
Yeah.
And so, yeah, that's a great strategy. People that I think what they should do, I always recommend this to buyers when it's time to file taxes, get an estimate from your accountant, have an understanding of what your tax liability is going to be and show what your adjusted gross income is. Call the lender, say, okay, this is what I'm showing. What can I buy?
Right.
And then before you file, you're like, okay, no, you might want to, write off a little less, show more income, and you can actually afford what you're going to buy. So I love doing that, estimate and then talking to a lender.
Yeah, absolutely.
Yeah.
Absolutely. And it's funny because the people who get that, when I have that conversation with them about letting go of this attachment to the interest rate and strategizing with your tax preparer, your lender, once they get it and it clicks, it's like a light bulb goes off in there. Oh yeah, this makes perfect sense. That I totally want to do this, and they just get all in on it, and
Right.
they never ask me about interest rate again.
Right. Yeah, that's great.
Yeah.
Did you guys know, like, I didn't know, and I hadn't been around long enough in the industry or been an owner long enough in the industry that during 21 and 2020, when the rates went like rock bottom,
Mhm.
did for me, it was like an afterthought that I refinanced a bunch of stuff.
Mhm.
Um, did you guys like know that this was the one old and only golden opportunity for your clients to refi?
I At the beginning of it, it was unclear. There was definitely a little bit of a sense for me of panic of, like, how am I going to get at that point, it was 18 years of database of clients. How am I gonna get in touch with all of them and tell them they need to refinance, uh, in a short window because I felt like the window could close at
Right.
any minute because it was such an unprecedented move that I really thought this window could close. Like, we might have 30 days, we might have 90 days. As it turns out, we had about 2 years, um, so most people got to take advantage of it. I had a team of about 20 different loan officers, working for me at that point. A lot of them were younger than I am, had seen a much shorter window of business than I had, and I tried to instill in all of them that this was not going to last and
Right.
that we were living in the golden age of mortgage lending, and they needed to act accordingly, as it pertains to their personal finances
Right.
and the opportunities that the market was presenting, in terms of establishing relationships and preparing
Right.
yourself for what comes later, what comes after. They didn't all take that advice, as you
Sure.
could imagine,
Yeah.
but I did realize it.
Right. It's interesting, you realize that you had that fruition wasn't, but what you also initially had was this fear that there's no way that you're going to be able to handle and service that many people in just this short window. So it was like this anxiety, like you were set up to fail and you're going to fall short, and this is nuts.
Right. Yeah, I mean, we were moving sand from one side of the beach to the other. You look down and you're like, "I didn't make any progress."
Right. But then it kept going.
Right, and it kept going, and, I think that most homeowners got the opportunity to take advantage of it, and it was a unique market for sure.
Okay, so then also, I love this because we're just giving, tons of little tips and tricks and, how to help navigate these questions that buyers and borrowers are constantly faced with. What about, when the rates, like I met a guy recently, the rates were up and he bought like 2 years ago and he did an ARM. So, when's the good time, or how do you advise people, which has been a common strategy with the high interest rates, is to do an arm.
So, the ARM market kind
And
of
you
went
can explain that, maybe some
right,
people
so an ARM is an adjustable rate mortgage, right? ARM, that's what it stands for, and, for
and
the
it's only going to be for a fixed amount of years.
yeah, back in the subprime days, there was true ARMs, meaning from day one, the rate was adjustable.
Okay.
Um, and so the way the rate then is determined is there is an index and a margin. The index is some sort of publicly published number for a yield or an interest rate. A lot of them they use the SOFR or the SOFR.
Okay, so this
Back in the
gives
day,
it
it
some
used to be
guardrails.
LIBOR, and then there was a margin on top of that. So it would be the LIBOR plus 2%,
Okay,
something
but it's
like
going to be
that.
fluctuating.
It was fluctuating.
Right. So
Now we mostly deal with hybrid arms. We're called hybrid arms, meaning there's a fixed period of time, usually 3 years, 5 years, 7 years, or 10 years.
okay.
The rate is fixed for that initial period of
Right.
time, and then it becomes adjustable, now every 6 months, usually after that. So you'd face 2 adjustments
Right.
if you live through
So
the adjustment.
when were you advising people? When would be a good chance that someone want to use one of those?
Um, when it's, 1, worth it, because when yields went down, when interest rates went down dramatically, the yield curve flattened, meaning the difference between a 10-year and a 2-year became nothing almost.
Right.
And actually for a while, we heard about, an inverted yield curve, meaning the rate on 2-year was higher than the rate on 10-year, which makes
Right. So people could
zero.
go 10-year,
Right.
and then on the ARMs, the rate's always going to be lower than a 30-year fixed.
Right, but during that period of time where the yield curve was very flat, there was zero difference between a 30-year fixed and a 5-year ARM
Ah,
because the yield curve was so flat. And during that time, it was everybody just take a 30-year fixed because you'll never have to think about it again. This is
right.
great. Once the yield curve starts steepening again and there's actually a benefit to taking an ARM,
And
then
when is it? What's the market condition to make that happen?
where the yield on maybe like the 10-year treasury is like today it's 450, and the 2-year, I don't even know what the 2-year is today. But the 2-year or the 3-year is usually what the ARMs are set on. Maybe if it's 250 or something like that. It's not even that big of a spread right now, but you want to get a benefit for taking an ARM, to offset that risk that the rate is going to adjust in
Right.
5 years, 7 years. So at that point, when it's worth it and you can get a pickup.
And that's usually when we're in a high interest rate environment.
Yep, right.
Okay.
Yeah.
Yeah.
Then it becomes, well, how long are you going to have this? Like, what's the risk associated with facing an adjustment in 5 years, 7 years,
Right.
10 years?
If you know that you're not going to have it for a long time, then for sure take the ARM if it's a lower rate. If you're
Right.
convinced you're not going to have it, or if you're convinced that the rates are going to go down,
Right.
and you're going to refi.
Yeah, and it's a bit of a personal choice too, in that people have different risk tolerances.
Yeah.
Right. Some people just cannot deal with the anxiety of having this date out there in the future where their mortgage is going to adjust, and they may or may not be in the house, and they just don't want that.
Right.
A lot of people just want to be set. They know I got the next 30 years. It's going to be X
Yeah.
every month.
Makes sense.
But for the most part, residential owner-occupied homes have no prepayment penalty. So you can refinance at any time. I mean, you're talking 30 days after you close. If it makes sense, you could refinance. Your original lender won't like it because they'll get what's called an EPO, an early payoff, and they'll have to pay back all money. We talked earlier about servicing a loan and selling a loan. If I close out a transaction for you, we turn around and sell it in the first 30 days, and then a month later, rates happen to go down dramatically.
Right.
And you're like, hey, let's refinance. Like, okay, but now that 200 basis points that I made when I sold your loan, I've got to pay back to that investor.
Right. Right.
Because they have an expectation that they're going to keep that loan on their books for
Right.
generally 6 to 12 months minimum, and they don't even start making money for 2 years.
Yeah, it's good thing for the consumer, though, that they can sell at any point in time.
Absolutely.
What other strategies other than, the QM, the non-qualified mortgage, that you see people when they're struggling to get into the market? LA is an expensive place
Very
to buy.
expensive.
I know you do business in Illinois and Chicago, not a cheap market
Right.
either compared to other places in the country. So what strategies are you seeing that people that want to buy are they utilizing? The equation is like satisfying for down payment money
Mm-hmm.
and for,
Monthly payments.
monthly payments.
Right. The best advice I ever got from Gloria when I bought my first home was just beg, borrow, and steal to get into the first home. That you have to, the sooner you get into that appreciation cycle, the better off you will be. It's like if you're just a salary person, start contributing to your 401k day one of your job when you're the first job you get when you're 21 years old, because it's going to serve you well to start early. And you're going to wake up 30 years later when you're 50, and there's going to be a lot more money in there. Similar to buying a house, the sooner you get into that appreciation cycle, the better.
Right.
So to answer your question, I would say do whatever you need to do, including low down payment loans. Most loans you can get into for 3% down, 3.5% down. That's still a lot of money in LA, but it's not completely unattainable.
Right. Exactly. And although the monthly payments are going to be high, you're in the appreciation cycle. If you can stomach the monthly payments, offset it with
Right.
some roommates, or if you're buying a duplex and you have some,
Right.
subsidy from the other rented unit, and you're in the appreciation cycle.
Yeah. And that's the other strategy that I always recommend, because it was my strategy when I bought my first place in 2005 was I bought a duplex.
Yeah.
I bought a 2-unit property and I rented out the other side, and that made me feel better every month.
Right.
Did I still have first place I bought was in Silver Lake. It was a 2-unit townhome style, next to each other, mirror images, 3 bedrooms, 2 baths. It was very nice. It was $880,000. I bought it with my girlfriend at the time, the one I had moved to LA with. We scraped together 3% down, which was about $25,000.
Was it FHA?
It was not FHA. This was pre-meltdown. There was all sorts of products for
Right.
low down.
Because now
they had 100%.
now they have
Pretty easy.
the 5% on up to 4 units,
Right.
and that's just been new since a couple years ago. But this
Right.
program was available back then.
Right. But the point was that, I was 25 years old or something.
Yeah.
It got me started, and the girl didn't work out. The house worked out.
Right.
We were amicable. We waited until 2014 to sell it, and I had already moved out. She had already moved out. We had
Cash
good
flow.
tenants.
Yeah.
We had cash flow. And when we decided it was time for us to part ways, and stop being financially involved with each other because we didn't have a personal relationship anymore, we sold it, and I got to take my half of that appreciation and do a 1031 exchange into a fourplex.
Yeah, I want to hear about that, and I'm glad that we're touching on this, because you're a service provider, you're a lender who actually puts your money where your mouth is, and you practice what you preach.
Right.
You're selling mortgages, but you're taking them on yourself, and that's something that's always gravitated me towards you, and we've traded ideas on that. I'm a realtor, and I also buy my own real estate. So let's continue on with that trajectory. So you did a 1031 exchange with your share of the proceeds from that duplex that was an income property, meaning you didn't have to pay taxes on what was probably a pretty nice
Right.
appreciation, and proceeds.
Right.
And so you deferred that as long as you bought another income property that you weren't going to live in.
Absolutely. So that's the way a 1031 exchange works, is that you can take all of the proceeds. You have to take all of the proceeds. You can't take part of it from the sale of an investment property and roll it into a new investment property and defer paying any capital gains tax on it whatsoever.
So you found a fourplex.
So I found a fourplex in Highland Park, purchased that.
What year was that?
That was so I sold the duplex at the end of 2014, and I bought that at the beginning of 2015. The reason that's important is because if you're going into a 1031 exchange, as you know, from the day you close on the sale to the day you close on not the day you close, but you have 45 days to identify up to 3 properties, and then you have another 180 days to close on one of those 3 properties. So a 1031 exchange takes some dedication and some effort, because you could get stuck holding the bag.
Right.
If you haven't identified a property, you don't close on a property, the accommodator who takes all of your funds when you're doing a 1031 exchange, if you don't meet those,
You have to pay the taxes.
yeah, they'll just take it. They'll send a portion off to the IRS and give the rest of it back to you.
Right.
Right. So
you found this fourplex. You're yourself living in a rental property, or you bought your home at that point in time?
So, in between, originally buying the duplex and selling it, the girl and I didn't work out. I had moved into downtown LA, and I bought a loft in the Eastern Columbia, and I was
A
living
famous
down there.
building, right?
Yeah, it's a beautiful building.
What made that building so famous? A few things.
A few things. One, it's historic and gorgeous. It's the
Art
It's the
Deco.
Art Deco, big clock, rooftop pool. It was the epitome of downtown LA 2.0, conversion of an old department store into these beautiful lofts, these gorgeous penthouses. And of course, that's the other thing that made it famous, is Johnny Depp owned 3 of the penthouses,
Right.
and got into his whole melee with Amber Heard.
Right.
there.
Yeah.
There's a little drama there, but
So you had one of those that you're living and occupying. So you're buying this fourplex as a
strictly as an
investment.
investment.
Right. Yeah. And you still have that one?
I still have it to this day. Um, I paid $798,000 for it. Now, this is 2015. Highland Park was on the way up, but it's not what it is now.
Right. So good
And
timing.
it was good timing. The cash flow was good. Wasn't excellent, but it was pretty good. And, since then, we've had 3 out of the 4 tenants turn over, some of them multiple times, pretty close to market rents, and
That's great.
it's turned out to be a cash cow. It's wonderful.
Yeah. And then you got another unit in the Eastern building,
Right.
right?
So the first unit I bought in the Eastern was in 2011 or 2012. It was about a 1,280 square foot unit, and there was a listserv that all the building tenants or owners were on. It was like an old school Yahoo group listserv, and people would just send out, "I need a dog walker."
Sure.
I don't know, whatever. "I need a painter." Whatever.
Okay.
It's just sort of sharing of information. I noticed my neighbor. I was in 602, 603, sent out a message that said, "Our tenant's moving out. The property's going to be available for lease, whatever, next month," or something like that. And I thought, let me just reach out to them and see if they would ever entertain selling it to me.
Right. Being right next door to yours. Yeah.
Right. But then I could take down the wall. I could expand into this, over 2,000 square foot loft if I wanted to. And sure enough, that proactive move, they said, "Yeah, absolutely, we'll sell it to you. We don't want to be landlord."
Right.
But
Okay.
the market was still kind of soft at that point. It was 2012, 2013.
Right.
The market was still soft from the Great Recession.
Yeah.
And so we agreed on a great price. I bought it. Wasn't ready to do a project to combine the two of
Right.
them. So I turned around and leased it out.
Yeah.
Wasn't good cash flow at that point. But I knew that I had the opportunity there to expand it and make this great big unit at some point. Never ended up doing that. But
But when you sold them both, did you sell it to the same buyer?
I did sell them to
Okay.
the same buyer.
Right.
So the listing agent for Johnny Depp's units, he was selling his units at this point in 2016, 2017. A man by the name of Kevin Dees, who's a great friend of mine. He's
Yeah.
a real good agent. I think he's with
Yeah,
Carroll.
for sure.
He's a great agent.
Yeah.
Uh, he had all of Johnny's listings, which were much bigger. The standard unit in that complex outside of the penthouses is anywhere from 900 square feet to 1,300 square feet, with a few mixed in that are 1,600 to 1,800 square feet. The penthouses were 2,100 to maybe, I think there was one that was 35.
Oh, I saw them. They had like lofts and multiple levels.
But they were divided up into different
So he had
levels.
people looking,
He had
and
people
and then he said, "Okay, I know about something that's more reasonably priced and a lower floor." And
Right,
Yeah,
but
so-
yeah, so when someone came to him and said, "I'd love to have 2,200 square feet, but I need it all on one level. I can't
Right.
do this like multiple levels type thing." We were in touch, and he said, "Hey, I've got a buyer.
Perfect.
Would you consider it?" So it was the first week of 2017. I took a new job, took a business partner, found out we were having a baby, and sold my loss in like a matter of like 5 days. It was crazy.
I love it.
Yeah.
I love it. It's so neat how real estate, can be at the center of like major life changes, gives you the momentum.
Mhm.
That's awesome. You touched on something, and then we're gonna move towards wrapping up. I want to ask you a series of final questions, but you mentioned Kevin Dees, who I know has a great reputation. He's
Yeah.
a very successful agent. Being that most of your business does come as referrals from realtors, what would you say that realtors that are successful are doing? What have you noticed that the ones that are calling you with lots of referrals, lots of buyers, how is their communication? What's the business that they focus on? What do you notice as a through consistent thing that these realtors are doing to stay top?
I would say that the most successful realtors that I deal with are, I don't want to use the word unemotional because that's not true. They all really care about their clients, but they're not hung up on any single transaction. They're focused on the big picture, giving a great experience, always doing the right thing for their buyer. And most of my interaction with real estate agents is in relation to a buyer, not necessarily a
Right.
listing. Sure, I talk to the listing agents and I interact with them on a regular basis, but as it comes to servicing a client, we're talking about how are we taking care of a buyer.
Yeah.
They're always doing the right thing for
Right.
that buyer, right?
Right.
They never have commission breath. They're never worried about closing this one
Commission
transaction.
breath. I've never heard that before.
They don't panic when things start to go sideways. Courtney Smith, who's a dear friend, who's now on the East Coast. She had a huge team in Northeast LA, Courtney and Kurt team for a long time.
Right.
But she's since moved back to the East Coast. One time, years ago, I just had this dread of calling her to tell her things were just going sideways for the underwriting on a buyer that we had under contract. And I'm like, I don't want to call her and
Right. You're
right?
supposed to be the one that closes.
Right, exactly. And I'll never forget. I called her. I had my hat in my hand, and I told her what was going on, and she said, "Great." She's like, "If we don't have a deal going sideways at any given moment, we're not doing enough business."
Yeah. I love that.
All right. I'm like, "That's a great attitude.
Totally 100%.
That's what we're in the business to do. We're in the business of solving these problems for people, right? If there's never any problems, it's probably because we're not doing any business."
Oh, I love that. That's so good. That's so good. It's so true. Yeah. I love that. Thanks for sharing that.
Absolutely.
All right. So in closing, I always like to ask guests a series of the same questions.
Oh, great.
The
There we go.
first being, looking back 10 years ago, what would you maybe have done different?
I would have been more thorough on data collection and CRM management and relationship management from a technological standpoint.
Yeah.
I think that as we're entering into this new age of AI and all these other things, that's going to be the most valuable resource that any of us have is our database.
Right.
And injecting our best human qualities into that data is what's going to serve our business.
Yeah.
Yeah.
Yeah. Exactly.
So if I had to do over again, I would have been extremely diligent about making sure that I'm maintaining that. Because it's taken a few evolutions now over the years of trying to piece it back together
Right.
and make sure that I have all of
Yeah.
that.
Great advice.
Sure, a lot of stuff fell through the cracks that I don't even realize.
Great advice, for anyone in any business. If you're a restaurant or a cafe, retain your database, because there's so many ways to stay in touch with them and you don't have to piece it together.
Yeah.
Going ahead 3 years, where do you want to be?
At this point in my life, my daughter's 7.5. She's in first grade. I've entered this stage where more isn't necessarily more.
Right.
I don't need to be so busy and have so many clients and so many transactions going that I can't focus on my family. So I think that's going to continue probably for me for the next 3 years. So the goal is, how do I maintain passive income through the units that I own, other investments? You and I have gotten into some investments,
Yeah.
which has been great. I love it that you'll call me and be like, "Hey, we've got this project going on. One of our investors backed out. Do you have any interest?"
Yeah. Right. That's going to give you more time to focus on.
Right. Because you're managing that project.
That's right.
Right.
Yeah.
I'm writing a check.
Oh,
and
the real.
I know you, and I'm like, okay, well, I know Ari's going to do a great job with it. This is truly passive income.
Right. That's where the real money is, and
Yep.
the real wealthy are putting their time and their investments.
Yeah.
That's great.
So continuing to grow the passive income is the goal for the next 3 years.
And being
Sure.
smart about what you spend your time on, and
Right.
and how much is quality over quantity, and where the returns are.
Absolutely.
That's great. And then what's favorite book, movie, or song?
Favorite book, movie, or song? Oh, wow.
You don't have to answer all of them, but
Right.
whatever jumps out.
Well, there's a great real estate book. I don't know if it's my favorite book of all time, but I would recommend everyone read Steve Scholl's Steve Scholl and Chris Voss wrote a book called The Full Fee Agent.
Yeah. And you
I
brought me a
I
copy
brought
of
you a
it.
copy
Yeah.
of it. I'm a big fan of Steve Scholl. Anyone who's looking for a real estate coach, I think I'm one of the few lenders who coaches with him.
Smart.
But he's got a great approach to coaching and business, and it's really just not about more transactions. It's about, how are we all going to find serenity and a quality of life that we appreciate. And sure, part of that is having a business that is thriving,
Right.
but it's not all that, right? It's not working 24 hours a day. It's not answering the phone at 10 o'clock at night necessarily. He loves to say, no matter how anyone is acting or screaming or yelling, whatever, the house is never bleeding. We aren't doctors. No one is dying. And I've sort of taken that and run with it. So that's a book. My favorite, what's my favorite movie? I'm kind of a fan of the late 90s art house movies that, like the Scorsese movies and the Paul Thomas Anderson flicks and that.
Yeah.
I've never been a big like box office guy, like the Marvel movies or anything like
No,
that.
right.
So
Yeah.
yeah,
Good.
yeah. So
Yeah. Great
kind of
answers.
boring, but
No, great answers. Yeah. I love that book, and it really goes in line with, trying to, choose what clients, a realtor shared with me early on, like success is when you can say no to business. And it's great to see you, focusing on that and being at a point where, you can, be more selective and not have
Yeah.
to take everything. So
Yeah, and for the young ones out there, I get it. It's hard. Like, what it's like when we're starting out. We're kind of like, where's our next paycheck going to come from?
Right.
Where's our next deal going to come from? Uh, you got to trust the process, and it does get easier. Like, there does come a point where you don't stress about, like, is this it? Is this the end? There was years that went on where I always thought this transaction I'm closing today might be the last one I ever close.
right.
It's so ridiculous.
Yeah.
It's so ridiculous, but that's just how you feel, and it does, that does ease over time.
Yeah.
Would you agree? Have you experienced that?
100%, 100%. But I've heard, old veterans still have that same feeling, and it probably actually motivates them. So it's about a healthy balance
Mhm.
in all we do. And, you share so much great stuff in this conversation. I learned more about you, and I really appreciate it.
Oh, thanks, Ari.
Appreciate it, man. Thanks for coming on.
Yeah. Take care.
Good job.